Hey guys, welcome to the 111 Trading Strategy Masterclass. We will learn everything you need to know about how to trade this and how I personally used it to make $5,923 in a single month. So let's dive in. What you're going to see is proof from my broker that I've actually done this. You can see here from one of my best months how I did about $6,900, which is insanely awesome. The back test here, I can see it's very consistent. There are some drops with stops, but still 90% win rate. You make about 200, you lose about 800, and overall it works out great, but I'll be showing you some tweaks later of how to actually reduce the risk massively. And you can see here other people who have implemented this as well, doing as much as $1,300 in the first month, $7,500. Anyways, you can just see this works. And so I'm super excited to teach it to you, everything you need to know. So here's the game plan for this video. You're going to learn why you should trade this, how to structure it, how to pick the right duration, the right strike prices, the DTE and all that. You're going to learn how to manage the trade based on take profits, stops, etc. You're going to learn the biggest risk factors for this trade and how to mitigate them. You'll also learn how much you need in your account, how to scale, how to do it with different assets. You'll learn how I personally trade, how I set up the trade, how to adjust it to different markets like bullish markets, bearish, etc. You'll also learn about the advantages and disadvantages so you'll be aware of what could go wrong and how to adjust it. And then you'll see a real trading example. I'll dive into the chart, show you how to understand how it works. Then I'll show you in my broker how to pick the right strike prices and what credit you're targeting and all that stuff. Then as a bonus on top, I will show you how to automate the 111 income strategy if you not only want the passive income, but you also want to do it hands-free. Let's dive in. Legal disclaimer, annoying but required. This is educational and entertainment and purposes only. I'm not a financial advisor. I definitely don't control the market. If I did, we would all be rich. Trading is risky and 99% of people lose money. Past performance does not guarantee future results, and you have 100% responsibility over your own trades and actions. If you agree to that, then continue watching. If you don't, then I guess nice seeing you. Why trade the 111 income strategy? It's a very simple mechanical trade. There's not a lot of guessing, worrying, looking at charts, things like that. You're just every single week, you're doing the exact same thing. And so it's super simple to follow, even for someone who's newer to options. Also, you don't have to read the chart. Again, I'll show you how reading the chart here later in this training, how it can help give you an advantage, but still the base of the strategy, even if you never look at a chart, is still very good. Guys, the months where I had my greatest success of around $6,000 a month, I never read the chart. I didn't look at the chart. It just did it. Okay. So it's a very simple mechanical strategy. It can easily be scaled. I'll show you how you can do this on a small account, on a large account, and how you can scale across different sizes and assets. I will show you how it has a very high win rate of 95%. How there's no risk to the upside, which is amazing. So many option strategies, like you're capped at how high you can go, but no matter how high the stock goes, you have no upside risk. And it offers larger payouts if the asset moves down, which is great as well. There's like a built-in hedge to it, which is always good for protection. And there's multiple ways to win and exit the trade, which we'll be discussing here later in this trade. So how do we structure the 1-1 income trade? It's very simple, okay? First, we need to understand what is the goal of this trade. The goal of this trade is to generate reliable monthly income, but do so safely. Okay, so include a hedge to help offset losses in a downtrend. So unlike other option selling strategies that optimizes for profit, this one, we look at profit, but also consider risk, and we add a hedge to it. And so how does the general market trade the strategy? Like the overall typical approach for this strategy is a 90 to 120 days out in the future. So that means you're looking at about 3 to 4 months in the future for this trade, which gives you plenty of time to for it to work out in your favor. And as we'll discuss in the risk section, the further out in time you go, 90 or 120, the lower your volatility risk, the higher your win rate, and the more profit you make, which I know almost everybody here wants. Now, how do we pick strike selection? So this trade, the 111, is broken up into 2 trades. It's broken up into a PDS, which stands for a put debit spread, and it's broken up into a short put. So the put debit spread is the 1-1. We buy one put and we sell one put. And the other one is a very far out of the money put that we sell. So again, the first two combined makes the put debit spread, or the PDS. And the second one is the short put. So for the put debit spread, we do a 25 long put. So a 25 delta long put. So we buy the put at 25 delta. I'll show you exactly how to find these levels in the broker. So don't worry if you're new to this. It'll be doing a 23 delta that you sell. And so that creates the put debit spread. And then the short put will be done at a 10 delta short put. So again, we're going to sell far out of the money, which is about 10 delta. But credit target, we're going to target about a $20 to $40 credit. I'm going to move my face and into the rest. Ideal assets to trade this on is going to be ES, CL, GC, SPX, SPY, things like that. So again, futures options are preferred because as you'll see when we get into the broker section, when I show you on the broker, you get an insane amount of leverage and get a great return on your money. And so that's why futures options are preferred. You also can reduce a lot of risk this way because futures trade overnight. And so most of the time market crashes start in the after hours and then really accelerate when the market opens and people actually start being allowed to trade. But if you're doing futures options, you're able to get out overnight before the massive crash. And so I've done that before and it's saved me thousands of dollars. And so all of those combined, I love futures options, but you can also do it on SPX and SPY. So how do we manage the trade? We just learned how to structure it and set it up, but we manage it by doing an 80 to 90% take profit. We have a 200 to 400% stop loss, and we don't really have an early management rule. This is how the general market does it. So basically, if we're looking at it based on an example, if we receive $20 in credit to put this trade on, we receive $20 to enter this trade, and we're doing an 80% take profit. That means that we're going to close the trade once the trade price gets to $4. Okay, so we started 20, goes down to 4. We've made an 80% profit and we'll close the trade. Now we're doing a 200% stop loss. Once it gets to $60, we would have experienced a 200% stop loss. And so those are some examples based on the credit. And so, yeah, that's how we structure those trades. Now, this is one of the most important sections is risk, okay? Because the point is if you can manage risk, almost any strategy makes money. Almost every strategy you found on YouTube makes money if you just learn how to manage risk. Now, I would argue the one-on-one is one of the best strategies around that you can use, but we still need to understand the risk, okay? So number one, the biggest risk is buying power risk, okay? So if you don't know what this is, as you're putting on one-on-ones, you typically enter this on a weekly basis. And so you'll have a lot of overlapping trades, right? So maybe you have 4, 5, maybe 6, 8 or so trades open at a single time. And if each trade has a stop loss max loss of about 3,000, well, now you have a lot of risk that you're looking at. But not only that, if you're doing futures options, the buying power required for that trade can go up if the market gets riskier. So let's say you entered a 111 and it took you $4,000 to put on that trade. It can then increase that limit up to 8,000. It says, hey, we now need 8,000 for this trade because the market's risky. And so it can do that. And there's a lot of risk. So how do we prevent this? The solution is we, number one, make sure that we have enough buying power. But number two, have hedges to offset the risk so that as volatility or as risk gets higher, these things offset that risk and make our account more stable and more consistent, which I'll explain further what hedges we use in a second. Risk number two is manipulation risk. This works or applies to all options trading. If you've been trading options for any amount of time, you know this to be true, okay? The problem here is when you do a stop loss or a limit order or anything like that, it can lead to losses due to market makers manipulating the options price. What does this mean? Okay, when in the options market, since it's less liquid than stocks, if you put your order out on the market, which means you do a stop loss or a limit order, that order then just sits on the market and anybody can see it. A market maker, a hedge fund, a bank, they can see these and they go, okay, this order is sitting at this price. So I'm going to move the option price just slightly to trigger that order. I'm going to take their contract and I'm going to automatically sell it and make money. Basically, if you've had a limit order or a stop loss order on options and it prematurely exited or it closed for no reason, this was it and they took money from you. And a ton of options sellers do these limit orders and are literally losing hundreds of thousands of dollars every single month because of this. And so the way that you prevent against it is you only submit an order when you're ready to exit. Okay. So you do this by when you're ready to enter, you immediately do a limit order at the current price. If you're exiting, you wait until you're ready to exit. Then you submit a limit order at the current price. You don't sit and wait. You just do it when it's time. Risk number three is volatility risk. This also applies to all option sellers. If VIX spikes, it can lead to huge and sudden losses. And so this VIX stands for the volatility index. So if the volatility in the market, the risk of the market goes up, then we could be losing money. And so how do we solve this? We adjust our buying power usage based on where VIX is. Let's say we only want to use $30,000 to trade with. Well, VIX is low. Let's say VIX is trading under $10, which is low. Maybe we only use $10,000. When VIX is, let's say, medium, maybe we only use 20,000. When VIX is at the highest, so we have the lowest risk, maybe then we go all in, right? So adjust your buying power usage based on VIX. So how do we actually size our account and scale it? Okay. So before we go into it, we need to understand the 30% rule. This is have no more than 30% of your account into trades at any given point. All that to say, if you have a $100,000 account, you should have no more than $30,000 in trades. This helps you have a decent cushion in case buying power increases, helps you to offset losses and allow a smooth equity curve because you're not investing everything. This prevents margin calls and all those issues as well. So how do we scale the trade? Okay, so once we know how much we should be using, how do we scale that as our account size grows or as we add money to it? And so if it's less than $10,000 in our account, then we'll do the 111 trade once a week, but on a smaller asset like MES, which can support it. Again, MES is not the preferred trading asset, but if you have a small account, this is all you can afford to do. Now, if you're doing $10,000 to $25,000, or you have that in your account, then you can do a 111 once a month. So once a month, less frequent, but we can do a bigger strategy on ES. So again, we can afford to do a more liquid strategy like ES or a more liquid symbol. We can only do it once a month. When we have 25,000 to 100,000 in our account, we can do a 111 once a week on ES. And when I do these, this is where I am. I do it on around Wednesday on every week. There's no reason for that. It's just because Wednesday is the middle of the week. I like doing that. So once a week on ES. If you're doing over $100,000, you can do a 112 twice a week on ES. And then if you have more than that, you can continue doing it twice a week, like Tuesday, Thursday, but then scale the contract sizing. Go from 111 to 222 to 230, and then you get the point. So now how do we hedge? Okay. A 111 can be turned into a put debit spread hedge. So as I mentioned before, there's 3 options in a 111, which is why it's called a 111. So again, you buy a put, you sell a put, and you sell a put. The first 2 is the put debit spread, and the last one is a short put. If you close the short put, you're then left with the put debit spread. And that put debit spread makes money as the market goes down. So it makes money as the market drops. And depending on what asset you're trading, this could give you as much as $2,000 of downside protection, which could cover the loss of a single trade. So as you put on a trade, then you take it off, and you close just the short put, then you can leave yourself on a put debit spread hedge. You could also just go out and buy a SPY or ES put on a monthly basis. So just say, hey, once a month, I'm going to buy a SPY or ES put. That way, if the market drops, the put will go up in value and it'll offset my risk. So you can do that as well. And what I've seen a lot of recent members in the options auto trader in my community do is they buy VIX calls on a monthly basis, right? Because if VIX spikes, we're in trouble as options traders. So they just buy a call on VIX. If VIX spikes, your profit goes up. Now, doing the puts on SPY will help offset your deltas. The VIX on call will really just help offset losses. Sweet. So now how do I actually trade this? How do I put this into action with my 5 years of options trading experience? How do I do this? Again, my goal is the same thing. Again, how can I generate reliable monthly income, but without suffering huge losses that require me to immediately bounce back? So if you've never been an option seller, how it works is a lot of times VIX will spike. We'll have a huge loss, we'll get out, and then the next 2 or 3 days, the market resets and we would have had a winning trade, but we got out and now we lost thousands instead of we could have made money. And so my goal is how can I generate consistent income without having to suffer huge losses that I close and then could have actually made money from? And so that's what my goal is here with the 111. So here's how I do it. Days until expiration, I go out to 120. Why? Pretty simple. As I mentioned before, the further out in time I go, the less volatility risk I have, because the more time I have for the trade to play out in my favor. I have a higher win rate because my strike prices are very far out of the money, and I get to collect more money, collect more profit. Overall, great. It means I'm in the trade longer, but it's a small cost for all the benefits I get. Now, how do I pick the strikes? Again, like I mentioned, this trade's broken up into two parts. They put debit spread and a short put. And so for the put debit spread, I do the 25 delta long put. I do the 23 delta short put. For the put debit spread and the short put, I just do a 10 delta. So that's how I structure it. My credit target's about the same, $20 to $40. If I can get more than it's a cherry on top. If I get under that, it's simply not the best trade because my risk to reward is not in my favor. But around 20 to 40 is the sweet spot. My take profit, instead of looking for an 80 to 90% profit, instead I close it at 50% so that I can turn over trades faster and get in and out. Why do I do this? This prevents me from having a long string of trades open. So instead of having 8 trades open at a time, so I have a ton of risk, instead now I only have 3 or 4 trades open because they close faster. And so I have less risk on at any given point. So this helps me reduce risk and close my trades faster. And so that's why I like it. Early management, instead of doing a stop loss, I do a 21 DTE management. Okay. So this means that I just let the trade play out. Now, this requires that I have a good amount of cash set to the side so that if the market does crash, I can withstand the ebbs and flows of the market. But again, if you're following the 30% rule, you'll most likely be good on this. And so again, that's how I structure that. But again, I do this and I'm able to survive these things because I only use a 30% max allocation and I manage my buying power usage based on where VIX is. When VIX is lower, I use less. When VIX is higher, I use more. And this way I'm able to adjust how much I'm trading based on the risk in the market. And this helps me massively reduce risk. I also use indicators to alert me to when the market may crash. And this helps me get out as well. And I'll show you that here when we get into the charting section. So here's the back test of mine. You can see here, very consistent, very smooth return. Again, if we're just looking at closed profits, again, if you're in the middle of the trade, you'll see a lot of fluctuation. But again, as based on just closing trades, you can see here very consistent. You can see here about a 99% win rate. So overall great. But the one thing to notice from this is right here, you can see the drawdown risk. So you can see while I was in the trade, it cost me a lot of money. And you can see here how it had a lot of risk specifically in 2020, which makes sense, right? You can see here a ton of risk. This is because the market's dropping and I'm in these trades. And so they're probably losing a lot. And so that's why I need to have enough money set to the side, like 70% of my account to help cover these ebbs and flows so the market can reset and it'll be better. Also, you wouldn't have as large of a drawdown if you change your account size based on where VIX is. But again, if you prefer to have defined risk, then just put a stop loss on the trade. Here's what it looks like compared to the original 1-1-1 backtest that most people do. Fairly consistent, but you occasionally have these drops in risk. This was smoother based on an outcome performance. But again, it just determines how much risk you want to take because this has way less drawdown compared to the other one. So now how do we trade this in different markets? Okay, if we're in a bullish market, which means that our highs are getting higher and our lows are getting higher as well. So the market's just moving up. That means that we want to do the ideal trade setup. So normal 1-1-1 and let it go, whether you want to use the default or mine, whatever, the 1-1 setup. If we're in a bearish market, which means that the lows are getting lower and the highs are getting lower, basically the market's moving down, then what we want to do is we want to consider staying out of the market. 99% of the time when the market is going down on a trending basis, not a single day or 2 days, because that doesn't matter. But if we're trending down, I'm just going to stay out of the market and then just wait for it to reassess. However, if you really want to be in the market, then what you can do is you can do a 1-on-1 where you increase the width of the put debit spread. So the put debit spread, instead of doing a 25 delta buy and then 23 delta sell, maybe do a 25 delta buy and a 20 delta sell. So this way there's a wider width between the two, and this will give you more downside risk so you can make more profit to the downside. But again, ideally just stay out of the market. Sideways markets, if the market's stuck between a support and resistance, so same highs and same lows, you'll just do the normal 1-1-1 trade as well. This is where theta decay will work most in your favor as well. What are some of the advantages of the 1-1-1? It generates consistent income. It's very easy to set up. Again, I'll show you here in a second. You just do 25, 23, 10. It requires very little adjustments. Again, there are some on the closing, but actually not too hard to do. It offers the ability to hedge while making money. The 1-1-1 actually generates its own hedge, which is great. So provides some downside protection. They can be stacked for continuous income, like I mentioned, entering on like a weekly basis, and then you close those trades out. And then now you have all these hedges that you leave on, which is great. And there's a ton of different ways to play it with different assets, different expirations and doing different widths for your PDS to determine how much risk you want to profit you want to the downside. And plus, it's also a good way to buy a stock at a discount. If you're trying to enter on a stock, you have the put debit spread to offset risk, and then you have the short put that can be assigned shares. And so you can do it that way as well. What are some disadvantages? What should we look out for? It does have the potential for very large losses. And so that's why we put a stop loss on it or allow our trade to play out further. It can be complicated if you're new to options because this is mainly a futures option strategy, which does mean you need to learn a bit about futures options. But honestly, I don't know all the details about it. I'm still doing fine to understand risk, which I've discussed here, but it's a bit complicated for newer people. It does require strict buying power management. You need to know how much money do I have in trades, what's working for me, what's working against me, making sure that you keep that in check. It can require hedging. So if you want additional protection, again, the one has hedging built in, but if you would like additional protection, you can do that, but it will cost you additional money. And it does have uncapped downside risk. So if you don't add a stop loss or anything, you could lose a lot on the way down. And if you're not trading this on futures, so like SPY or a stock, you will have assignment risk. So you could be assigning shares, which typically is fun. So let's dive into a real trade example. Let me show you the chart. Let me show you my broker. Let me show you how to actually put this into action. Okay. So first we're going to dive into the whiteboard. And so I can just recap what we've learned. Okay. So let's say this is a stock. The stock is just trending higher, doing its thing. It's currently trading here. How a 111 works is we look at, okay, we want this stock to in general go higher. If it goes flat, we'll be fine. If it goes down, we'll be fine. If it goes down, we'll make more, etc. But how does this actually work? Like I mentioned, we buy a 25 delta. So we buy one put here. Then we closely sell another put. This creates what is called the put debit spread. This right here makes money as the market goes down. I'll show you here in a second. And then we go further out of money, okay, further away from where the stock's trading, far away. And then we sell another put. And this is just the short put that we have. It's SP short put. And so this is how this trade is structured. And what it makes it look like is like this. So if we stay in this zone, which means that the market stays above this level here. So anything above here all the way up to infinity, the market goes up, it's in this level, goes sideways in the level, goes slightly down, we're in this level. But every time we're in this level right here, this is going to be standard profit. For me, when I'm doing ES, it looks like it's about, so don't I do another dollar sign, about a $500 profit on these trades. And then again, if it happens to drop lower into this level at expiration, again, you have to let it expire to see this profit, but you'll be able to see a 2 or 3 X profit. So you'll be able to see about, let's just say $1,500 profit on this. And so this is because the put debit spread is now making money, but the short put is also making money. So you can see here the short put, it has to be above it to make money, which it is. And the put debit spread has to be below it to make money. So both of these are now making money. So you get a higher payout. And again, this happens at expiration. So basically 1-1-1, buy put, sell put. So that's how this works and how it works. No upside risk, do have downside risk. But if it does slowly trend down, you get a max payoff. Which is even better than your normal payout. But most time you just make this amount, and then occasionally you'll make this. Okay, cool. So how do we actually do this in the broker? How do we actually understand this and trade this? Let's go to the trade tab where we see this. And again, like I mentioned, this is best to do on futures options. So I'll do ES. You can also do this on others, but this is ideally a futures options trade. So ES or MES for a smaller account, but ES is preferred. Again, I'm just going to set it up how I set this up, which is a 120 DTE trade. So what I do is I look at the strikes and I look for the one that's closest to 120 days out. So I scroll down here, you can see I have 112, 132. So 112 is going to be the closest to 120. So I'm going to click this. Next, the right side are my puts. Okay, so I'm going to look at the puts first. I'm only going to look at the puts. Sorry, I was getting confused there for a second. I'm only looking at the right side. And so I want to make sure that delta is selected so I can look at delta, because remember, I pick my strikes based on where delta is, right? So I'm going to pick the one closest to 25 and the one closest to 23. So 24 is the closest to 25. So I'm going to buy this. Oops. Sometimes it does this. You need to refresh the screen real quick. So I'm going to buy the one closest to 25 delta. Then I'm going to sell the one closest to the 23 delta. That's how I structure this trade. I'm going to buy this one. Then the next one closest to 23 is 22. So I'm going to sell this one. This creates my put debit spread, my downside protection. You can see right here, as the market moves down in price, I have this green zone. That means my profit. But if we go further down here, 10 delta is where I'm going to sell this put. And just like that, now this is how you structure the 1-on-1. You can see here my max profit on this trade is 4,000. Now, again, we can see here EXT, which is actually like my extrinsic value, which is how much money I'll actually make. So you can see here 1,500 and then 4,000. So what do each one of these numbers mean? So if I go back here, 1,400 is the profit that I make if the market does it, or if the trade does its normal thing. Oops, does its normal thing. So 1,400 here. And then the 4,000 is my profit if it gets down to this max profits. So this is the max profit of 4,000. This is the normal profit of 1,400. Most of the times we'll hit the normal profit of 1,400. So that's what this is. Now again, 94% win rate, very great trade. Remember, we do a 50% take profit on this trade. So since my normal profit's 1,500 based on this credit is what that's based on, that means my actual profit for this trade is going to be about 1,500 times 50%. So I'll make about a $750 return for this trade, which is great, right? Because I'm in this trade for about a month, maybe shorter. And so it can work out great for me. But what I really want you to notice is the buying power effect. How much money am I putting up to actually enter this trade? And for ES, it's actually a great number. So you can see here, I'm going to make $750 on this trade in about a month, which is great. But I'm only putting up about $5,500. That means I'm making a 13% return on my money. In 1 month, I'm gonna make a 13% return on the money that I invested. And so that's why a 111 is incredible, right? 13% return, literally 13, 20, 100 times better than any interest you'll get from a bank. And so again, 94% win rate, great trade. And this is how I do the 111. And this is how you set it up in the broker. Just simply enter and then exit based on your take profit and stop loss. Again, take profit I just mentioned would be once you reach a profit about 750, and then stop loss would just be this amount times 2 or 3 if you have a stop loss, or just holding through if you're doing that as well. So now that we know what the trade is and how to enter it, I did want to make sure that I mention how to reduce risk by looking at certain indicators, okay? And this is completely free. So if you go to TradingView, which is the free charting website, and you can also do this on your broker or any place you look at charts. Again, if you don't look at charts, that's completely fine. A strategy can still work for you. But if you want to have a little bit of an edge, let me show you how. So first thing we do is I use this indicator, which a lot of people know of, but they don't know how to change it to make it work best for them. It's called the Bollinger Bands indicator. So I'm going to add this. Most people look at it like this, but we don't want to do that. We actually want to make a change here in the settings. We want to change the length from 20 to 200. So when I do this, it changes the middle line. This changes it to a 200-day moving average, which kind of smooths out the curve for some long-term results. And what I do is when the market is outside of these bands, it's outside of a normal trading range, which means it's at a higher likelihood of pulling back and resulting in a crash or pullback. So if we look at it, when the market breaks here, you can see it led to a down move. The market ran up here, broke it here, and then came down, broke up here, went down a bit, all these things. So this is how I assess when the market is at a higher risk for turning around and if I should offload some of my positions or if I should get out entirely. And so if you see here, what I do is I wait for the market to break above it. Then I wait for it to break down below it. So right here would be an example. And then what I personally do is I just wait 30 days. So I can't spell, but 30 days, you get the point. When it breaks down, I wait 30 days for the market to reset. This typically gives it enough time to do whatever it wants to do. Then I would get in a back around here and then I'd restart my trading process. You'd be like, Austin, I don't want to wait 30 days. Okay, then go through a $50,000 loss, like your option. So this is what I do. Again, it won't work all the time. As you can see here, it does tend to give me good signals on when to get out, when to not. You'll have a lot of signals where you're like, okay, wow, it hit here, but then it did nothing. Okay, that's fine. You had the chance of getting out before the market crashed. And so this is how I reduce a lot of risk and a lot of market crash risk by looking at when is the market overextended and making sure I stay out during periods I'm not. And this is a completely free way to do it. Perfect. I hope you guys enjoyed the screen share, learned a bit more, but I do have one more bonus thing to show you, which is how to automate it, right? And so our whole goal with selling options is to not only generate income, but do so safely. But at that cost, a lot of people then get glued to the screen and they're not able to spend time with their wife, with their kids, their hobbies, actually enjoying retirement and playing golf. And so then they become a slave to the computer, which sucks. So I'm going to show you how to automate it now. I've given you everything you need to just go trade this yourself and do it and make a lot of money, which you could go do. But if you want to automate it, this is how it's super simple, just 4 steps. There, 4. All right. So let's turn the strategy into a bot, which is passive hands-free income. Okay. And this is how I did it too. So number one, if we need to sign up for an automation software, something that will allow us to automate this strategy. And so there's a few options. You have option alpha as one. They allow you to automate options. They have some account safeguards, and they offer paper trading, which is great, but they don't offer any great customer support, and they don't allow you to do a futures options. That might be a disclaimer or something that couldn't help you there. Trade Steward, they do allow you to automate options. They will give you the ability to do strangles, which is awesome. They give you the ability to do 111s, which is great, but you can only do it on stocks and indexes, so that's fine. But if you want to do it on futures options, you would need something else, and they don't offer paper trading, so you don't want to test it first. Then you have the options auto trader, which allows you to automate options, has safeguards, allows you to do the 111, allows you to do it on futures options, and also has great support, right? Responding in less than 3 hours, gives video responses when needed, has 4 supported brokers, and offers paper trading. If you wonder why that's so great and why I use it, I built it because I wanted something great. And so this is the one that I've literally spent the last year and almost 2 years now building, over 600 members using it and making money. And we have over $40 million connected. So the options auto trader, if you want to do a one-on-one futures options trade, is the best one for you. But again, you can also explore the others if you'd like. So step 2 here is connect your broker account. So go to the options auto trader, create your account, and then connect your broker. We support the most brokers. So we support Schwab, Tastytrade, TradeStation, Tradier. Again, we've had their security teams go through our system and they have loved it. I have literally heard from every one of these brokers that like, oh my gosh, your platform is amazing. And so that's why we're connected to so many, because they love it and it's secure and it's great. So now that you connected your broker to an automation platform, you then need to plug in the rules of the 111 into the system, into the software. And so basically you'll just take all the rules I gave you and you'll plug it into the options auto trader, which I'll walk you through here in a second. And then after you do that, you just sit back and you let the bot safely generate monthly income for you. You can see here $7,500 from one of my accounts, almost $3,000 from another. And it's great because this is all done for me. The risk is managed, exits managed, entries managed. It's all good. And I get updates. I can check on it whenever I want. So let's look at a quick 5-minute demo so I can show you how this is done. Okay, it might even be done less than that. Here's my account here that I've been doing the one that I've strangles with. You can see here $3,000 in the first month. This has only been running for a month now. We're going to go over to this account here. This is where I'm running my S112, which is just a bigger version of the 111. You can see there, I made about $6,000 so far on this trade, which is great. But let's look at how to actually turn this into a bot, right? So you're going to click on Create Auto Trader once you've joined the Options Auto Trader and you connected your broker. Then you can make a bot. So click on Create Auto Trader. Again, it says I know all the rules for it. I'm just going to click on Create an Auto Trader. I'm going to do the 111 strategy. And like I mentioned, you can do it on ES or MES if you have a smaller account, but ES is preferred. Days until expiration, like I mentioned, I go 120 days out in the future. So I just plug that in here. I do 25 delta, 23 delta is the one I buy, the one I sell, and then I do a 10 delta for the one I sell. Again, this is best practice, and that's why it's plugged in for you by default. This is how you structure it. If you want to structure it a different way, just plug in how you want your strikes to be picked. And this is how I structure the trade. So I just plug in those rules. Next, I tell the bot how often I want to enter. And so for me, it's like a weekly trade. So I do a once a week on Wednesday is typically how I enter this trade. And so again, if you have different rules for that, you can do that as well. Now, how do I want it to exit my position? Like I mentioned, I like doing a 50% profit. I personally just close the entire trade when I close a 111 at 50%. And then remember, I managed it at 21 days. But if you want to add a stop loss, if you're going for an 80% profit that you can turn into a hedge, you can do that. Again, the software will also automatically turn into a hedge for you. If you want to turn it into a PDS hedge at the take profit, so once you hit your profit, just close the short put. So you can do that as well. I'm just going to close out the entire position and set this up as I typically do, like this. So now I told the bot what to trade, when to enter, how to exit. Now I get some safeguards of how do I want to protect my account. And the first way I do that is by telling it how much money this bot's allowed to trade with. Let's say I wanted to use $10,000, which will probably only be enough for one single trade, which is fine. You can just like that one trade we enter. But this is the cool part. Other safeguards. Remember how I mentioned we can massively reduce risk by changing our buying power based on where VIX is. If I just enable this, it does that for me. You can see here VIX space buying power. So if VIX is high, which means I have less risk, it's going to use the whole $10,000. If VIX is low, meaning my risk is high, it's only going to use $5,000 to trade with. This is insanely cool. One click and I can change my risk based on the risk in the market, which will massively reduce my risk. So if I'm looking for consistent income with very low risk, This one setting does that. But not only that, remember how I said we can use the Bollinger Band to see when the market's crashing, we can offset trades with that? That's exactly what the market crash safeguard is, right? You enable this, and now when the market shows that it's overextended based on the Bollinger Band, it'll actually start to offload some of your trades so that you can decrease your risk in case a crash does happen. So just like that, I've decreased like 80% of the market risk. And I'd be like, listen, but what about like manipulation risk? You said that's a thing. Exactly. When your order's sitting out on the market, there's risk because it can get triggered. We don't allow that to happen. We monitor your trade every 60 seconds and we update and close the trade only when, like we send in a close order, only when it needs to be closed. That way, nobody can manipulate the order because they can't see it. Anyways, just like that, you eliminate a ton of risk and also still get the upside. So if we continue on, that's how we create a bot. We can see the profit and loss graph. We can see all our settings set and explain it. And then we can set the auto trader live. You can see here an example of some I have. You can see here how it turns it into hedges for me, the profits and all that stuff all mapped out here for me. So that's how simple it is to not only take the strategy and run with it, but to automate it. Whether you want to do it manually or not, I've given you everything you need to profit. And if you think the options auto trader is cool or awesome, and you want to use it to automate your trading, whether it's a one-on-one or maybe a different strategy, click the link in the description down below and you can get started, or go to www.optionsautotrader.com/get started. Now, whether you do or not, don't worry. You have everything you need in this video to use the one-on-one to profit and generate monthly income. So go do it and let me know your results down below. All right, guys, have a great one and put this into action.